Welcome back, everyone, to the Noob Selling Options channel. So glad you're here because I am incredibly excited to bring you today's explainer. We are looking at an absolute giant of the modern era that has just suddenly violently stumbled. Yeah, we're talking about Netflix. Specifically, we're going to unpack its massive stock drop from its all-time high of $133.91, all the way down to a fresh 52-week low of $72.88. Ouch, right? It's a dramatic haircut. But the question we really have to answer today is this. Is this a true generational buying opportunity, or are we falling for a massive psychological illusion?
Okay, let's systematically dismantle the traditional bull case. Today's agenda. First, we'll look at the value trap illusion, followed by the growth stall reality and their failed M&A and strategy. Then, we'll dig right into the content debt squeeze, examine some existential AI and demographic threats, and finally, finish up with a clear investment verdict.
All right, section 1, the value trap illusion, psychology versus numbers. We really have to start here, because investing is just as much about human psychology as it is about the cold, hard math.
Right now, there is an intense psychological tension playing out, and it's basically driven by this one number, 45%. That is the staggering drawdown Netflix has experienced over the last 12 months. It's huge. When retail investors see a premier blue-chip brand slash nearly in half, well, our brains immediately scream generational discount. We get historically anchored to that $133 high, which makes $72 feel like an absolute steal.
But that brings us to the most important question of this entire explainer. Does a lower price tag actually mean the company is cheap? Think about it. Just because it's cheaper than it was last year, is it a fundamental bargain today? To actually answer that, we've got to strip away our historical anchors and look at the actual business engine running underneath the hood.
Moving to section 2, the growth stall reality. The premium is stripped. To figure out where the stock is going next, we first have to understand why Wall Street gave Netflix such an incredible premium in the first place.
So, for a decade, Netflix was basically treated as a pure growth tech darling. It frequently traded at a massive 40 to 60 times price to earnings multiple, mostly because it had an open, completely unpenetrated global runway. The sky was the limit. But here is the forward reality. Management has locked in their full-year 2026 revenue guidance at $50.7 billion to $51.7 billion. And what that translates to is top-line growth decelerating into the low teens, so 12 to 14%. It means organic subscriber growth is hitting a very real terminal ceiling.
So the crucial point we have to think about is what we are actually paying for that 12% growth. At $72.88, the stock is trading at roughly a 23.5 times trailing earnings multiple. And sure, 23.5 looks incredibly attractive if you compare it to their historical 60x multiple. But fundamentally, it is still very, very rich for a business that is only growing its top line at 12%. Especially when you factor in the reality that Netflix pays no dividend yield to help establish a structural price floor for the stock.
All right, section 3, failed M&A and strategy. This is about strategic limbo. See, a huge part of the bull thesis over the years was that Netflix would use its massive free cash flow to go out and buy legacy media libraries or, critical tech infrastructure. But let's look at what actually happened in the first half of 2026, because it brilliantly illustrates a management team that's kind of stuck in a dangerous limbo right now. They bid on Warner Bros. Discovery to get that premium catalog, but then withdrew in February, losing out to Paramount Skydance. Then, they entered a huge bidding war for Roku to secure connected TV infrastructure, but lost that in June to Fox Corporation's $22 billion offer. So now we are just left with speculative rumors about a mid-tier studio acquisition, like Lionsgate. And honestly, while walking away does show some financial discipline, losing Roku leaves their ad-tier rollout heavily dependent on third-party infrastructure.
That takes us to section 4, the content debt squeeze. We really need to look beneath the hood here. Netflix bulls absolutely love to point to their reported Q1 operating income of $3.96 billion and their 32% operating margins as definitive proof of health. But we have to look much deeper into the underlying cash flows.
This all builds into what is known as the content debt trap. So unlike a pure software company, say Microsoft or an Adobe, that writes code once and scales it infinitely at almost zero marginal cost, streaming economics are brutal. They dictate that Netflix must continuously recreate its product every single season. And with content amortization costs absolutely peaking, the heavy capital injections required just to keep existing users from churning are quietly eroding their true economic margins.
Furthermore, those big Q1 numbers we just mentioned, they have a massive asterisk next to them.
Remember that Warner Bros. Discovery deal they walked away from? Well, Netflix collected a massive $2.8 billion breakup fee from that. And that fee artificially padded their Q1 cash and created a massive one-time earnings pop. What that pop is doing right now is actively masking a much more concerning underlying trend. Basically, the organic cash conversion of their core streaming business is actively tightening.
Let's look at Section 5, AI and demographic threats, or what I call existential headwinds. Whenever we try to calculate the terminal value of a media company, we naturally assume it's going to command pricing power 10 or 15 years down the road. But Netflix is facing some massive forces that directly challenge that assumption.
The threat landscape is evolving so incredibly fast. First up, we have short-form creep. The attention span of demographics under 30 is heavily fragmenting. They are actively shifting their viewing hours away from traditional 45-minute premium streaming episodes and moving straight toward algorithmic short-form creator ecosystems like YouTube and TikTok. Second, the AI democratization threat. The rapid advancement of high-fidelity AI video generation tools is drastically lowering the barriers to creating content. And while you might think that helps Netflix lower its production costs slightly, the broader impact is pure commoditization. It vastly increases the global supply of generic entertainment, which just severely dilutes the value of Netflix's closed, walled garden subscription model.
Finally, Section 6, the final investment verdict. Is this deep value, or is it a trap? We've broken down the stall, the M&A failures, the debt, the threats. So is Netflix at $72.88 a deep value play, or are we trying to catch a falling knife?
I really want to frame this with a fantastic quote from the legendary investor Peter Lynch. He famously noted, "The biggest losses in the market come from buying a growth stock whose growth has suddenly stopped, assuming it can't go any lower." And while this describes Netflix perfectly right now, it is a highly profitable, deeply entrenched business, but it is fundamentally a stalwart in transition. The days of unbridled hypergrowth are squarely in the rearview mirror.
So here is the final thesis conclusion. We simply cannot mistake a 45% discount from the highs as a fundamental bargain. Currently, Netflix has a PEG ratio sitting near 1.8, an aggressive competitor base, an unproven ad tier scale post-Roku, and slowing organic revenue. So for me, I will not look at Netflix at this price. It just isn't truly cheap until the PE multiple compresses to actually match that low-teen growth rate, which would bring it closer to a traditional value staple multiple of roughly 15 to 17 times forward earnings.
Which leaves us with this final question for your own portfolio. Will you step into the value trap just because it feels cheap right now? Or will you exercise discipline and let the knife finish falling? I really want to hear your thoughts on this, so let me know down in the comments. If you found this explainer valuable and you want more deep dive analyses that cut through all the market noise, please hit that like button and absolutely make sure to subscribe to the Noob Selling Options channel. We have a lot more of these explainers coming your way. Until next time, stay disciplined and happy investing.